Hey, what's going on, guys? Welcome to this video. I'm going to talk about technical analysis, debunking technical analysis myths, things that people think are true just because they saw it in a YouTube video. Let's get to it right now. Here we go. This is Verillo Trading. Like the video if you enjoy this type of content. Let's get to it. All right. When I first got into trading, I was watching a channel known as The Chart Guys, and I would recommend them to any beginners if you just want to get a good foundation of some basic technical analysis ideas. Actually, where I'm at today, a lot of the stuff they cover in their videos, actually, I would consider for a day trader, doesn't give you any edge whatsoever. So the point of this video is not for you guys to agree with what I'm saying. It's simply for educational purposes. You might be able to gain some insight from it. And if you do, fine. If you don't, then whatever. What I'm going to say is that a lot of this technical analysis stuff, I'm going to try to present to you some of the flaws in it. Okay, so let's start. The first thing you learn about in technical analysis is this. When you look at a market and it's doing this, higher low, higher high, higher low, and higher high, you consider this an uptrend. When a market is making higher low and higher high, it apparently is a signal that you should look to buy only. Now, how do you know that when the market is making higher highs and higher lows, that it's going to continue making higher highs and higher lows? For example, what if the bigger trend of the market looks like this, right? And then all of a sudden you see this, higher low and a higher high. All right, let's buy. Well, what's going to happen is probably the trend is going to continue. Now, just because you see a higher low and a higher high, some traders think that that's a signal that the trend is reversing. In fact, that is something that can be very misleading. So what I'm trying to say is that if the market does this, that is not a signal that the market is now in an uptrend. Same thing as if the market does this, that is not a signal that the market is in a downtrend. Just because the market made a lower high from its previous high, that the market is actually in a downtrend, you have no idea. You might be looking at the tape and then the market just starts going up and then 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 up and takes out all the highs, and then guess what? Then it reverses. This is the kind of stuff that happens, and this is why I think technical analysis is flawed, because on YouTube you'll watch a video that says, all right, if the market's making higher highs and higher lows, you should look to buy, and that's considered to be an uptrend, right? If the market's in a downtrend and now we see a trend reversal, I should look to trade a reversal. But in reality, reversals are usually fake outs that end up in the larger trend continuing. Now, how do you filter for that stuff? Well, guys, in this video, I'm just trying to debunk typical patterns and things that you see on the internet about technical analysis. Look, I've been doing this for quite a while, and I've been subject to a lot of these pitfalls. And what I'm trying to do by making this video is to say to newer traders, look, guys, don't trust everything you see on the internet, right? Just because a guy made a YouTube video an hour long where he's got a high quality camera and he's showing you all these technical analysis patterns really cute and stuff, do not believe everything you hear on YouTube. Don't believe everything I say either. All right, the next thing is candlestick patterns. Here we go. So what a candlestick is, essentially, if you don't know, is that the range of the bar represents the price range over a specific time period. That's why you often hear these traders talking about 5-minute candles, 10-minute candles, 1-hour candles, daily chart candles. So the length of the bar you select will basically show you the range of prices from the lowest price to the highest price in that time period you've selected. So let's say that this is a bar worth 30 minutes of time. In this case, the market traded as low as here, it traded as high as here, and then the other two inputs that we're concerned about are the opening price of the bar and the closing price of the bar. Those are the 4 pieces of information we get. I'll repeat them. The lowest traded price of the bar, the highest traded price of the bar, the opening price of the bar, meaning the price of the market at the time that this bar started to form, and then the closing price at the time that candle closed. So in this case, this bar opened here, it moved down, then by the time the bar closed, it was up here again, meaning that this area was traded, but the market ended up moving higher after about 25-30 minutes. Some traders would look at this and they would call this a bullish reversal candlestick. What the problem with this is that you don't see what happened in this bar right here, all right? You don't know if there was a significant amount of trading activity that occurred here and that there's actually a high probability that it goes to test it a second time. You don't see that. Basically what this bar is telling you, that the market opened here, moved down, and then came back up before the bar closed, and it closed up around the same price, a little bit higher actually. So this bar on its own, in my opinion, does not give you a bullish reversal signal at all. Now, when I first learned about candlesticks, that's what I learned, is that when you see a lower wick or an upper wick, you call that price rejection, that the market rejected trade in these areas. But in reality, that's 100% flawed because you've been watching the market and you can very clearly see, I'm giving an example here, that the market did not reject trade in this area. In fact, there's a high volume area right here. The market didn't reject trade there. And then the market will typically come back to test the area and then move somewhere else. What I'm trying to get at here is that simply because you see a lower wick or a higher wick on a candle, it does not mean that the price rejected. Let me give you an example of price rejection now. Here's an example of what price rejection actually looks like. So let's say the market's in a trading range and then all of a sudden we go down, and in a short amount of time, the market just bounces back up into what we would consider to be fair value in that moment. Now, you would see it very clearly if this was price rejection, because what would happen is that the market will sweep down and then bounce right back up quickly. That's price rejection. Whereas if the market did this, came down, spent a lot of time here, that's not price rejection, that's price acceptance. That means we traded here. Now on a 30-minute candle, we can see price opened here, traded here, and then by the end of the candle, we're back in this range, and the candle's gonna look like the one I showed you here, signaling a bullish reversal. But in reality, there's no bullish reversal. We had fair value here, and now we're testing this one. Doesn't mean it's going higher. In fact, probably it's gonna go and test that one again. So again, I'll just continue a bit on candlesticks. Okay, so let's look at a couple of these candlestick patterns. So in this case, bullish engulfing, right? So what they're saying is that if the market closes above the high of the previous bar, or if it has a large body compared to the one previously, then that is a signal that the market is now going to continue higher from there. Okay, let's say these are our 5-minute bars. Okay, after 5 minutes, this market closed up higher above the high of this bar. Let me ask you something. How is that a signal that the market is now going to continue higher to new highs, right? We've tested the high of the previous bar, and this bar, for whatever reason, after 5 minutes of time, is now above the high of the previous bar. How is that a signal that the market is now going to continue higher from there? It broke above the high of the previous bar, and now it's going to continue higher. Do you see how that logic is flawed? There's no indication saying that when it breaks above the high of the previous bar, it's going to continue higher. In fact, I would make the opposite argument, which is the fact that what I would call weak holders often will keep their stop loss right above the high or low of the bar. The bar will tick through it and then come back into where fair value is. All right, just an example. What I'm trying to get across is that there's no probability indicating that when the market trades the top tick of this bar or closes above the top tick of that bar, that it's going to continue higher from there. Okay, there's no probability indicating that that's actually going to happen. There's no statistical data that indicates that that's going to happen. Okay, past performance is not indicative of future results. Same thing with the close below or above the candle. The market closed below the low of this bar. Okay, all that means is that if these are 5-minute bars, after 5 minutes, the market moved lower and closed lower. How do you know it's not going to just come back into where it was earlier? So again, these candles on their own do not provide valuable information. They give you contextual information, but they don't provide you information about the live market trading. My opinion only, okay? Okay, here's the last thing here now. Support and resistance. Okay, this one's quite funny. Okay, so this is what most traders or beginner traders or these YouTube proclaimed trading teachers claim to be support and resistance. It's this right here. You look at a market potentially in a range and you say, okay, the highest traded price of that market, that's the resistance point. All right. Why? I don't know, but it is, okay? So then likewise, you'll say, okay, the lowest traded price of this trading range here, that's a support zone. So when it gets to the support, right, I'm gonna buy right here and put my stop right under the low. Guess what happens? It goes straight for your stop, and then it continues. And guess what? You kept averaging down your position, and that never ends well. So there we go. And then the highest tick of this bar, okay, that's the resistance point, $62.03 on crude oil. All right, so when the market gets to $62, I'm gonna start selling crude oil. What happens? It goes straight for your stop loss. Why is that? Well, probably because this is not real resistance and this is not real support. It's simple as that. So what I'm trying to say is I'm trying to debunk the fact that if you think that the highest traded price of your trading range or the lowest traded price of your trading range, if you think that that is the support, you're gravely mistaken. A lot of people are going to say, well, look, if all that stuff is bullshit, then how do you get the real stuff? I'll give you maybe just a little bit of guidance. So I use volume profile and market profile to understand the context of the market from a greater perspective. What we will often see is the market trades volume in one area in a session, for example. It will move away from that, and then potentially it will come back to test it in some way or another. For example, this week on NASDAQ futures, we saw a bit of a down move. Now, if you looked at where the market traded to, we traded right to fair value areas from the previous trading weeks. For example, this one was right here, right around this 855. On Wednesday, when the market started to sell off in the afternoon, as soon as we started to enter this previous value area and reject the upper extreme of it, the probability was very much in favor of the bears that we were going to continue to trade through this area and see some lower prices temporarily. And I banked on that. We saw the market accept trade in this previous value area. And then overnight, we kind of consolidated and saw a bit more downside. Now, if we go back and look a little further, we can see there's a couple of other value areas here that traded, one of them being 12,735 all the way down to 12,606 and all the way down to 542, which we have not traded yet on NASDAQ. Traded as low as about that 600 marker on the NASDAQ, and that is as low as the market was willing to accept in that time period. As the market moved higher into the close on Friday, we moved up to test the previous value area of Wednesday's trading sessions. All right, so what I'm saying is that real support and resistance, real areas that act as inflection points for the market, they come from areas that the market actually did business in the past, right? So what happens is this area here, if the market is now moving up with no clear areas of resistance or battle zones nearby, what happens is the market starts to move up. There's no clear resistance, so it's going to go all the way to where it previously found value in the past, and they traded right there, and that's where the market closed, right? So this is just a concept. Some of you are going to say, well, how do you find real support and resistance? First thing, learn how to read order flow and learn a little bit about volume profile and market profile. All right, guys, that's going to be the end of the video here for today. If you enjoyed it, leave a like and a comment, and I'll catch you later. Take care. Bye.